Well, hello and welcome to this episode where, you know what, we're actually going to find out some great details about one of the things that is so important to people. And we're basically not talking about emails popping in or stuff on social media. What we're talking about is mortgages. We're talking about where you live. We're talking about the rest of your life, potentially staying in the same house, or we're talking about buying a new house and moving on to another area because maybe you've had children, maybe you've changed your job, whatever it is. It's all about movement, right? And it's all about living, and it's all about enjoying ourselves when we're doing all of that and not having all the stress and stuff like that comes along. So what we're going to talk about today is how a first-time buyer can sort out their own mortgage and get their own place to live, right? So, and with me today, I have got a super expert to talk about this. Now, Dave, you are this super expert of which I refer. So why don't you tell us a little bit about yourself so we know how much of an expert you really are?
Well, firstly, thank you for that very bigging me up introduction. So my background initially was I was in the army for a few years and then met my wife and came out and ran my own taxi business. But always had that. My wife worked in a bank for 40 years and I always sort of had that interest in the sort of financial sector. I decided in 2006 to jump in with both feet and take my mortgage exams. And I mean, at that particular time, it was quite easy to get a mortgage that wasn't as regulated as it is now. You could basically invent what you actually earned just to get a mortgage. It was that, unfortunately, that I think was part of why the market crashed in 2008. So a lot more regulation came in, which was the right thing to do. So yeah, I've been in the industry now coming up for 19 years, so quite a bit of experience. I've been in the market myself as an house owner since 1987, when houses were quite a lot cheaper than they are now. Yeah, well, I mean, I think my first house, a 3-bedroom house, cost me £35,000. Now that particular property is probably in the sort of £280,000 mark. So it sort of gives you an idea of what happens to house prices. I mean, historically, house prices have always gone up. You know, you do have the bumps in the road. You know, we had a recession. Some of you might remember it. If you're a first-time buyer, I don't think you will, but there was quite a big recession in the late 80s and early 90s. There was a little bit of a rough ride in sort of 97, 98. Obviously, we had the 2008 massive recession there. You know, I think we're in that sort of ballpark at the moment after COVID. I always thought when COVID came in and they were handing out, these furlough money and grants and stuff like that, it did worry me that it's going to come back and bite us where we don't want it to bite us because we've got to pay this money back. And I think that's where we are now. So it's actually a good time. It's a good time to buy. I've had 4 houses. I think I'm on my 4th and hopefully my last. So yeah, just going back to about house prices, they, as I say, over time they do rise. You will get some bumps in the road, but ultimately is a good investment. It is one of the biggest, alongside your pension, it is the biggest investment that you will ever make.
No, definitely. And I think that's the thing, isn't it? It's about really understanding the investment that you're making and understanding the complications and also the benefits of it, right? So if you're looking at this from a first-time buyer's point of view, what are the very first steps really that they should take when looking to apply for a mortgage, like practical things? What sort of early stage advice would you give, to do with credit checks or to do with savings or, all the stuff that works up to getting the mortgage? Maybe you can talk us about that, that beginning part, because I've heard some horror stories about first-time buyers having to work on their finances for ages, maybe a year or so, before they're actually in a position to be acceptable to a lender.
Well, I think if you're young at the moment, well, it doesn't necessarily mean if you're young. I've got a couple of clients I'm seeing at the moment, they're 42 and 52, they're first-time buyers. So it doesn't necessarily mean that you're 21, 22 and you're the first-time buyers. It goes through all ages. But if your plan is eventually to buy a property, then definitely that one of the biggest things for getting a mortgage is your credit. It does determine, where your mortgage is going to be placed. So when I talk to clients initially, be it first-time buyers or any client, but when I talk to a first client initially, the 3 things that matter are obviously you need to have some income because it's all based on your income. You need to have a deposit and you need to have fairly decent credit to get a decent rate. I'm not going to say it doesn't matter if you haven't got good credit. If you've got some what we call adverse sort of credit on your reports, when we talk about adverse, we're talking about things like or missed payments on a credit agreement like a credit card or a loan or a mobile phone contract or something like that. That you're sort of classed as good adverse if it's the odd misdemeanor, if you like. You've got the bad adverse, which is your counter court judgment, CCJs, bankruptcies, defaults, that sort of stuff. But it doesn't necessarily mean that you won't get a mortgage. It just means that you're not going to end up on the high street with people like your recognised lenders who are, NatWest and Nationwide, where your rate might be 4.5% or 5%, whereas if you have to go with a non-high street lender, you're looking at rates probably 1.5%-2% higher than that sometimes. So
sometimes, of course, if people have been in trouble or whatever, what that means is they'd end up paying more for their mortgage.
Yeah.
Which is kind of counterintuitive, isn't it? It doesn't make any sense. But you'd think that they would make it, well, no, if they're businesses, I get it. But you'd think that somehow they'd make it easier for somebody to pay their mortgage off, not more difficult. But I guess it's the same with cars as well. But anyway, sorry, I interrupted you.
Yeah, your credit score, your credit report, credit score, it's not just important for your mortgage. I mean, it's important when you're going for things like car insurance, mobile phone contracts, loans, credit cards, all that sort of stuff. And I mean, I'm old school. I remember my father saying to me, when I was younger, don't get a credit card, don't get a loan. The only thing you need to get into debt for or get a loan for is the mortgage. But things have changed so much. I mean, I'm going back probably 40 years. Things have changed so much now. And I had to go to see the bank manager to get my mortgage, whereas now you've got brokers and you've got people within the bank that aren't managers that do all this sort of stuff. And the checks that they run on you one of them is your credit score. When I speak to a client, let's say it's a first-time buyer, the first thing I do before anything is get a credit report for them. And once they've got that, it doesn't cost them anything. Once they've got that, I'll get them to send it over to me, and then I'll pop them an email back, and I'll go through the credit report in detail and give them advice on what's good, what's bad if there is anything bad, what they can do to improve it. And it tells me so much about their current situation, and basing with that and their pay slips, I can then give them a really good idea of what they can borrow.
So that's interesting. So for a first-time buyer then, I don't know, what would be the average age for a first-time buyer that you've dealt with, do you think then? I mean, I know you've said obviously it can be older.
Yeah. They're in their sort of mid-20s. I mean, you can't sort of judge them all the same. There's some very sensible 25-year-olds out. They haven't got a car loan, and they don't go out every weekend. They don't have takeaways 3 days a week. They're really knuckling down and saving hard. Whereas you've got the opposite end of the scale of they've got a car on PCP and they've got a credit card that's loaded up, and they're going out every weekend and having takeaways and stuff. So some people will have quite a large deposit, and it does surprise me sometimes. The bigger deposit that you've got for a mortgage, it means that you'll get a better rate. So lenders, when you're buying a property, and I suppose the easiest way to describe it, to sort of give the example, if you've got a property that we all wish that was only costing £100,000 and you had a 5% deposit, which is £5,000, then that's classed as 95% loan to value. Now, the rate on that would probably be up in the maybe 5.6% at the moment, maybe higher. If you had a £10,000 deposit, that's 10%, but that's 90% loan to value. So the rate comes down, and they come down in sort of 5% jumps. So 95% loan to value, then 90%, 85, 80, 75%, and then generally it drops down to the rate drops at 60% loan to value. So it's quite important to have a bigger deposit. Not necessarily you have to, but it does help your monthly payments, because the bigger deposit you've got, the less you're going to borrow, which means the monthly payment is going to be cheaper.
Okay, so that makes sense. So that's making me think about, how do lenders assess how much a first-time buyer can actually borrow their discretionary income that you talked about? So in other words, going out, having takeaways, all that sort of stuff. Does that play into their decision? Basically, what the story behind the income versus outgoings and what's left over each month that can be used for savings, I guess, towards a deposit. I mean, do they look at that?
That depends on which lenders you go to. If you're on the high street, then basically the lender will look at your income, your pay slips, and it'll either be, if you're a single person, they're just going to look at your gross annual salary, or if you're self-employed, some will look at your most recent tax calculations, which is your gross income before tax, so after all your expenses are taken out, or they'll look at the joint income for the both of you, and then they'll look at your outgoings, and the only outgoings they're interested in are going to be any commitments that you've got, like a loan. Credit cards, they'll look at the balance and assess you on that, and that's it. The rest of the stuff, they'll just base it on the Office of National Statistics as to what your commitments are going to be. It's quite a straightforward thing, but one thing that they do hate to see, and it's quite prevalent now with youngsters because it's so easy to do it on these things, is gambling.
Really? I thought you were going to say like something like shopping. Instant shopping.
No, it is an issue nowadays because it's so easy to do it. And I don't know if the people listening to this or yourself, you watch telly and every single advert break. To me, there's a gambling or sometimes two gambling adverts, and it's quite easy to get sucked in. I've spoken to people that have got into 20 grand's worth of debt in the sort of last 8-10 months. They've only just started, and that's how quickly sometimes it can get hold of you. But lenders, if they see that on your bank statement, that could be the difference between them saying yes to a mortgage and no to a mortgage, because that massive red flag to a lender.
That makes sense.
Yeah, absolutely. But most of the high street lenders generally don't ask for a bank statement, which again, we're back to having good credit, so that we want to be on the high street with the high street lenders, and it's so much easier to deal with, especially for people like myself as a broker. It's selfish, really. I want you to be on the high street. I want to put you on the high street with a high street lender because it's easier for me, because they're a lot easier to deal with. But the benefit to you is you're getting the best rate according to your circumstances. Whereas the lenders that perhaps you've never heard of, like Bluestone and Pepper and Precise, they'll be asking for bank statements, and they forensically look at your outgoings. And that, as I say, it can, with the gambling, is a big no-no. But even aside from the gambling, those non-high street lenders will look at your bank statements forensically to look to see how much you are actually spending on your hair and your nails and your takeaways and your, all the other bits and pieces. Amazon. It's a lot more involved than I think people sometimes realise.
No, absolutely. Okay, so the takeaway from that is, if you're a first-time buyer, get your ducks in order, make sure that your credit is good, make sure that you're saving for as big a deposit as possible so you can get the lowest rate possible, and go with a high street lender, which will just make things a lot easier. If you don't do those things, then you're going to be going to other lenders who, well, basically take more time. I suppose they would take more time, but I guess they are more careful with who they're lending to, even though they're charging more.
Yeah, but at the end of the day, all the lenders are looking at is the risk to them, because they're taking the risk. If you're only putting down $5,000 on £100,000 property, the risk to them is a lot higher, because they're in it for $95,000.
So explain that risk, because people possibly don't understand, the loan to value thing. Explain how that works.
Well, if you bought somewhere, let's say 2 years ago, or maybe even last year, early last year, you bought a flat or a property, let's say a property for £100,000, and you put $5,000 down, you put 5% down. The risk to the lender is quite high, because they're putting $95,000 into that. Property prices, I don't believe what they're saying in the press at the moment. They're saying that property prices have gone up. That's not what we're seeing as brokers. I've had a client, I've just done their mortgage for them. The property that they bought or they're buying was £600,000 last August, and they've just got that for $535,000. So that's a 10% drop. If you sort of then put that into my example, you buy somewhere last January, last year for £100,000, you put down £5,000 deposit, the lender's done it, given you a £95,000 loan, that property price dropped 10%. The property's only worth 90, the mortgage on it is still going to be sort of 94,000, because you won't pay much off in a year. That's the risk the lender's taking, and that's why they charge higher rate for when you're putting down less of a deposit. Well, as I say to all of my clients, but especially first-time buyers, don't worry about if your property goes down. Sometimes that happens. It's really hard to judge when is the time to get into the market. You want to buy at the trough. You don't want to buy at the peak. It's like buying shares. What's happened in the last, 3 weeks with Trump? The market's crashed, and now sensible people have started buying into shares now because the market is low. People ask about renting for the rest of their life, or should they buy? If you buy a property for, let's say again, for £100,000, you have a mortgage for 25, 30 years, and you pay the mortgage off at the end of 30 years, your property's still worth £100,000. Well, it's yours. But if you rent for 25, 30 years in the same property, all you're doing is paying somebody else's mortgage off, and at the end of 30 years, you've got nothing. And your mortgage and your rent will go up. Landlord is sensible. He'll be putting your rent up every year. I have rental properties myself. I do put my rent up every year because my costs obviously go up with a mortgage and stuff. So I think I'm not going to say it because I'm a mortgage broker, I want you to buy a house, but I think it's that and the pension are two of the best investments that you'll ever make.
No, absolutely. And I think that's the point here. So people think that, renting's handy, because you can move around, you can be mobile, you can do all those sorts of things. But there is a time when you do want to settle down and actually make changes to the property that you're in, which of course you can't really do with renting. You might be able to paint a room, but you should really get permission to do that from the owner, right? Yeah, there's all sorts of swings and roundabouts. So what sort of mistakes do first-time buyers make in the process of getting a mortgage, beforehand or anything else? What can you tell us about that, things to avoid, basically?
I would avoid, I'm not a car person, but I would avoid, lumbering yourself with debt. The lender will always look at what your income is coming in and on what you've got going out. A car loan, a PCP or whatever for a car, it's going to affect what you can borrow. And I cover all this in the chat that I have about the credit. It's a free service I offer to any client. They can come to me and I can have a chat with them. I don't charge them for that. And I'll run through their credit report. And even if their credit is great and they come back to me and say, well, we're not actually ready yet, that's fine. They've got a bit of free advice about, how they can build their credit. But things like having a credit card, it's not simply having a credit card. If you've got a credit card and it's loaded up all the time, lenders look at that you're living off the credit card. You're living beyond your means. If you've got an overdraft and you're in that overdraft all the time or a lot of the time, lenders will see that and they'll interpret that you're living beyond your means. So all of this advice comes in prior to me doing anything. And sometimes first-time buyer might come to me and I'll do their credit reports and they'll need to tweak things a little bit, and it might take 6 months or 7 months for them to get back on their feet. If they've been gambling, they can clear that. Lenders will only ask for the last, if anything, they'll only ask for the last 3 months bank statement. So clearing things like that and maybe getting themselves a credit card or getting themselves out of their overdraft or clearing their credit card, so they might not be ready. So they'll go away and hopefully with my advice improve their credit rating and then come back to me. I know that every client I see, I'm not going to be able to help. That's just life. But I had first-time buyers come to me saying, oh, we're thinking about buying in about 12 months. We've done their credit reports, we've looked at their income, and I've given them an idea of what they can borrow, and they bought a house 3 or 4 months later. It's quite an interesting thing to do. It's really nice helping people out, and that's why I love my job at the end of the day. It does massively. I hated the job that I did 30 years. I was a taxi owner. I run a business for 30 years, and I did not like any of it apart from the fact that it earned me quite good income.
Yeah, I can imagine. Yeah, that's quite a thing, isn't it, being a taxi driver and things. Okay, so let's have a look. We're doing really well for time here, but I think this may well be our last question for now.
Yep.
Can you talk us through the mortgage products that are available for first-time buyers? So in other words, what's all this stuff about fixed rate, variable tracking? Yeah, go on. Go for it, because
all right. So there's a whole, most people go for a fixed rate. The fixed rate, you'll get offered 1 year fixed rate, 2 years, 3 years, 5 years, maybe 10. Most people sort of go between 2 and 5 years. It depends on the situation at the time. We was having this conversation 5 years ago. I was constantly saying to my clients, if you don't fix for 5 years now, then you're going to regret it, because
Dave, hang on a sec. So let's explain literally what fixing means then.
Okay, yeah. So a fixed rate basically is a rate that will stay the same for the term that you choose. If it's a 2 year fixed rate, the rate will stay the same for 2 years, and your monthly payments will stay the same for 2 years.
Ah, there you go. Well, that gives you certainty, doesn't it? That's a good move.
Exactly. And then a 5 year fixed rate does exactly the same. And at the moment, the 5 year fixed rates are very slightly cheaper, but that's because the lenders, I think rates are going to drop on a high rate. At the moment, we're generally recommending 2 year fixed rates. And tracker rates, they're generally based on the Bank of England base rate. So they'll move up and down. Your tracker rate, you might have a 2 year tracker rate that will move up and down as the Bank of England base rate moves up and down. So there's a risk to that, because you can't budget as well, because you don't know what the bank is going to do with the base rate. So if the base rate goes down 0.25, your mortgage rate goes down 0.25, and your monthly payment goes down accordingly.
Does the tracker, so would they say we're going to track the Bank of England rate we're going to track it, so basically say it's 1% or whatever, and then they add a percentage on top of it?
Yeah, so you're probably looking about, depending again, all of the rates, the fixed rates, the tracker rates, they again are all dependent on the loan to value. So obviously the better loan to value, the better rate that you're going to get, fixed or tracker. But generally it's maybe 1% higher, generally on an average, 1% higher than the Bank of England base rate. So if the Bank of England base rate, I should know this, I think it's 4.25 at the moment. I should know. Yeah, we'll get it. Yeah. If you've got a tracker rate that tracks at plus 1%, it will be, if the base rate is 4.25, you will be 5.25, and then base rate goes down to 4%, you will go down 5%.
I can see that in the olden days when interest rates used to fluctuate all the time, that was possibly quite a good thing, because lenders weren't offering fixed rates that were acceptable, if you know what I mean. But what about nowadays? Why would one choose a tracker over a variable mortgage, right, where the costs of the mortgage change all the time?
So some of the tracker rates don't attract what is called an early repayment charge. So lender offers you, let's say, a 2-year fixed rate, then built into that, because they're offering you a fixed rate and it's not going to change, they want you to stay on that rate. But if you want to get out of that, if you want to pay your mortgage off, there'll be some early repayment charges built in. And generally, on a 2-year fix, it would be 2% of the mortgage balance in the first year of the fixed rate and 1% penalty in the second year. So if you borrow £100,000 and you want to pay it off, and you fixed it for 2 years and you wanted to pay it off in the first year, it's going to cost you £2,000 to get out of that. And then the following year, it will cost you 1%. So it will be £1,000. So going for tracker rates, some of the tracker rates attract slightly less early repayment charges, but some of them don't have any early repayment charges. So you might find somebody doesn't want, so they're coming off of the back of maybe a fixed rate, and they've, a lump sum of their pension paying out in sort of 6 months. And rather than go on the lender's standard variable rate, which is going to be up in the 7s at the moment, they'll opt for a tracker rate without a penalty, so that in 6 months' time, when they get their lump sum from their pension, they can pay their mortgage off and there's no penalty. That's generally, I've been on a tracker rate since 2007. Mortgage I've got, it doesn't exist anymore.
Actually, for first-time buyers, that would be quite good, wouldn't it? Because if you didn't know where your job was going to take you, and there was a potential that you'd have to relocate, for instance, from down south up north or whatever, then that would give you the opportunity to be able to move without actually worrying about wasting money by having to pay those exit charges or whatever they're called. What were they called? Early repayment?
Early repayment, yeah. They're referred to as ERCs, early repayment charges. No, that's actually not right. No. So again, depending on, this is credit-based, obviously, depending which lender you go to, but most of the high street lenders will offer you a mortgage that is portable.
Excellent.
You don't have to necessarily pay the mortgage off and then remortgage because you're moving up north. They will allow you to, as long as the onward property that you're buying fits their criteria, so if it's standard build, then it's fine. They'll allow you to move the mortgage, port it to the new property.
Fantastic. So then, there you go then. So really what it's about is, say, your scenario where there is a lump sum of money coming in later on and they know that it's going to be coming in at that particular time. Oh, that's good. Well, it's nice to hear that mortgage companies or mortgage people that offer mortgages will actually allow you to move that or port it, as you said, make it portable. So that's all right. Okay. Well, Dave, do you know what? We could go on for hours, couldn't we, right?
Okay.
But I think I've got to ask you the last question here for now. What advice would you give to someone who's starting out, who, I don't know, who maybe is renting, maybe they're in their early to mid 20s, something like that, and they're thinking about their first home, because they're in a relationship perhaps. I think that these people feel, and I know this from experience with my kids and stuff, right? They feel a bit sort of overwhelmed by all this. So how can we make them feel sort of like happier and warmer about this whole process? What words of Dave Grass wisdom do you have for them?
Come and see me. No, I'd say to clients, I wish that I had the advice that I'm giving to people now back when I bought, because there's so much out there, there's so much to consider. I think for a first time buyer, I would definitely recommend seeing a broker for at least your first mortgage, simply because someone like myself who's whole of market, so when we talk about whole of market broker, we're a broker that can go to any lender out there. I think the only lender I can't go to is Lloyd's, but they don't offer their mortgages to any brokers because they've got such a big share of the market. They don't offer their mortgages out. But then we go to Halifax. We can go to Halifax, which is part of the Lloyd's banking group anyway. But I can generally, with a credit report and some pay slips and knowledge of what deposit the client has got, I can generally give them an option of 3 or 4 lenders who they can go to and do the application in a day. Whereas if the client is going to go direct to, let's say, Nationwide, they've got to book that appointment. If they can get the appointment, I don't know how quickly they would do that, or any of the lenders would do that. And if they go through that, it's normally about 2 hours they would spend with me or the broker they see in the branch or on Zoom. I think they do it now. The broker does an application with Nationwide and it turns down for whatever reason. That client has then got to go to another lender and another lender. So it's all time as well. And the broker fee that we charge covers the time that the client be spending going around to all the branches trying to get, Yeah,
right. I mean, the thoughts of having to go from one building society or bank to another one, I think that's what makes people overwhelmed, really, because that's that's hard work, and it really is intimidating, isn't it? You got to sit there, and talk about your finances, and basically you're begging, please give me a mortgage, please, right? And that can be quite. So if they come and see you or a mortgage broker, they've only got to beg to you.
No, I wouldn't put it as begging, but you're right. The most time that people will spend with me is probably going to be about 2 hours, and that's when we go through. It's called a fact find meeting. We go through all of their personal and financial details and history, credit, address history, and all that sort of stuff to enable us to go to a chosen lender, and do an application. So that 2 hours. And also the other thing is, I don't know, I'm not speaking for other brokers because I don't know that. I don't go to other brokers for a mortgage. I do my own. I'm quite free with my time. I'm easily contactable. If somebody phones me, if I'm busy, I'll know that they've called, and I'll ring them back. And whatever questions clients have, and I always say to them that if you don't know the answer, it's not a stupid question. If I don't know the answer, then I'll go away and find the answer and come back to you. So I think that the advantage that we have over branch brokers is we are a lot more accessible, and we're, I see clients from 7 o'clock in the morning, sometimes till 8 o'clock in the evening and weekends, simply because, they can't get the time off during I don't know if you call it normal office hours on Friday, but I think with us being more accessible gives us quite a big advantage over the in-branch brokers. And you go to a Nationwide or NatWest, they're only going to potentially give you a NatWest or a Nationwide mortgage. We'll look at everything, and we'll look at the best rate that suits your individual circumstances. And that doesn't necessarily mean it's going to be the best rate on the market, but it will be the best rate that suits your circumstances. And we all other things like protection as well, which we could probably discuss at another meeting.
That makes sense, Dave. So basically what you're saying is it's just easier for people to be able to deal with a mortgage broker like yourself, and they can come and see you put your arm around them, and you basically guide them through everything and discuss what needs to be discussed, and then go off and do the nitty-gritty on their behalf, right? So that they don't have to sit there and be interviewed all these times, right? I can see the benefit, Dave. I can see the benefit, and I can also see that we're running out of time. So listen, Dave, it's been brilliant talking to you, because I think this is great, and I hope that our listeners are really picking up some juicy information from this, and at least feel a little bit better about looking for mortgages as a first-time buyer, or even at any time. Hopefully this has helped you to understand that. Yeah. So Dave, I'm going to give you the last word here. So why don't you tell us how people can get in contact with you, and what's the best way? Telephone, email, what? Go for it.
A variety of ways. I mean, we all use mobiles probably more than we should, but we've got a website which is omni-finance.co.uk. My email address is dave@omnifinance.co.uk, without the hyphen. This was all done before I joined, so I don't know. You can call me on my mobile. Quite happy to give you my mobile, which is 077 909 10002, or we have an office number, which I, again, don't know off the top of my head, but I'm going to give it to you, which is 01424 236 903. Now, just to finish off and explain how we work, we do charge a fee, but I don't charge anything until I do an application. So if people come to me and I'll do their credit report, I'll give them an idea what they can borrow. If they then come back and say, right, yeah, we want to move forward with this, we do the fact find meeting. I then go away and research a bit more, come back to them with what I think is the best offer out there, or best rate out there for them. And then I'll ask them if they want me to proceed with a decision in principle, which is a DIP. That's how it's referred to. And if that comes back as okay, well, then it's at that point where they decide if they found somewhere that they want to proceed. And if they don't, and they say, well, actually, no, we're not ready, there's nothing out there at the moment, we're going to sit back, it's not cost them a penny, but they've gone away with some really, really good advice. Certainly the most important, or one of the most important things, is the credit, and they've got some really good advice about how they can improve that.
So there we go. So there we are. Dave Grass, thank you, from Omni Finance, the top mortgage broker that we've spoken to today. Thank you very much for that. Yeah, brilliant. Thank you very much, Dave, and no doubt we'll talk again. Okay. Thank you very much. I really appreciate that. And listeners, ask Dave some questions, put some comments down below, find out, what you need to know about getting your first mortgage, your second mortgage, your third mortgage, whatever, and also find out about all these trackings and all the tracker mortgages and variables. Any questions you've got, Dave is our man. All right, he's our expert. So get in touch and let's find out. And hopefully, Dave, you can help people along. I'm sure you will be able to.
Well, that's what I'd like to do.
Excellent. Well, thanks very much, Dave, and until next time, see you all later.
Cheers.